Hey everyone, I hope you all had a very happy Thanksgiving last week. And as everyone knows, Thanksgiving kicks off the holiday shopping season. This week's video will focus on retail sales and the implications for commercial real estate. The first thing I want to highlight is that retail sales, excluding autos and gasoline, are at an all-time high $500 billion for the month of October. That's up 3.1% in real inflation-adjusted growth from last year and up by an inflation-adjusted 21.3% since October 2019 before the pandemic. Think about that for a minute. In just the month of October, U.S. retail sales totaled $500 billion, roughly equivalent to the entire annual economy of Ireland. That's a lot of spending coming into the holiday retail cycle, which is forecast to top last year by 6 to 8%. The total holiday sales estimate, including food and beverage, because everybody loves a holiday party, is expected to reach about $1.1 trillion, the best holiday sales total ever. Why are industry analysts forecasting such robust spending? There are four major reasons. As of October, there were over 153 million jobs in the U.S., an all-time high, and unemployment of just 3.7%. In addition, wages are up 4.7% from last year, taking them 14.1% higher than before the pandemic. Add on top something I've mentioned frequently in past videos: personal savings are up about $4.4 trillion compared to before the pandemic. Finally, it looks like retailers may try to clear off some inventory leading into 2023 and may put some deals out there. So, most people are employed, their wages have been gaining ground, and they have money in the bank. Basically, according to consumer surveys, people are ready to splurge a bit this holiday season. Even with recession risks on the radar for 2023, the holiday sentiment is positive. Increased spending is generally good news. It'll give retailers and restaurants a shot in the arm, boosting their revenues, but also invigorating their retail space needs. Although many thought the retail sector would sputter and crumble because of the pandemic, the sector actually held up comparatively well. Nationally, the total retail vacancy rates in the third quarter was the same as it was in the third quarter of 2019, just 4.8%. Of the 50 leading markets our research team tracks, 22 have a lower vacancy rate now than they did before the pandemic. It appears the sector has once again dodged a fabled retail apocalypse. The survival of retail is almost Darwinian, like a species dodging calamities by evolving, adapting, and mutating. Retailers and retail centers have evolved from being a cluster of stores that sell stuff to becoming experiential hubs that blend stores with restaurants, services, and activities. Today, a neighborhood retail center may have a grocery store, 3 or 4 restaurants, an eye doctor, a dentist, a cluster of shops, a gym, and a financial advisor. Not only is that convenient for customers, but it delivers a variety of cross-selling opportunities for the tenants, and it diversifies the property's income stream. A diversified tenant mix is key. Consider that in 2015, total restaurant sales climbed above grocery sales. Then in 2020, during the pandemic, grocery store sales surged and restaurant sales dropped. The trend reversed again in 2021 as the economy reopened. Another spending shift we're starting to see is from goods to services. Sales of both have been climbing since 2021, with goods taking the lead at the start. But in August this year, the growth of services sales began to outpace goods, and that trend may hold for a bit. These fluctuations reiterate the value of having a diversified tenant mix, especially considering the economic risks that may emerge in 2023. The retail sales momentum looks good for the remainder of this year, but as always, investors need to keep their eyes on the horizon.